Hey, it's Clint, Larry's analyst over at the Opportunistic Trader. And over the holidays, we want to talk about some of the themes that could impact the markets in the year ahead. And today, I wanted to go into inflation a little bit deeper. So, explore kind of the trend in inflation that we've had over the last couple years, what 2026 could bring, and how that could impact some areas of the market, most notably the stock market, along with commodities. So, with that, let's jump right into a couple charts and talk about inflation. All right, so on here we have the CPI, the Consumer Price Index. This is the headline figure that includes everything, not the core figure that excludes food and energy prices. And take this back about 10 years, and there's been I would call it three distinct inflation phases that we've seen over the last 10 years. It started with called the Goldilocks zone, where CPI mostly bounced between this 0 to 2% level. That allowed the Fed to stay, mostly accommodative with monetary policy. We had several rounds of or QE happening back in here, quantitative easing, and so. And this level of inflation is very supportive for the stock market. I'll get to the reason why that is here in just a second. And then we had the pandemic hit, and the aftermath of the pandemic. It was really the surge in inflation was really driven by two things. One was stimulus, not just monetary stimulus, but stimulus in the forms of basically checks that were put directly and money that was put directly into the pockets of consumers that could be readily spent. And then you also, so that's on the demand side, and then on the supply side, you had the impact that the pandemic had on supply chains and disrupting global supply chains. And so the combination of those two things sent CPI to 9%. This is in mid-2022. The CPI accelerated up to 9%. That was the highest level since the early 1980s. And we know, during this episode, we had the Fed start to raise interest rates that sent the stock market into a bear market. But then in mid-2022, we saw the peak in CPI at 9%, and then we started a trend of disinflation. So disinflation is just, you still have rising inflation. That's a year over year increase. So again, that's what this blue line plots. This is the monthly year over year increase in CPI. Disinflation is when that year over year increase is positive, but at a falling rate. So we went from 9% back toward this 3% level, dipped below 3% for a few months in 2024 and 2025. But we never returned on various inflation measures, consumer inflation measures. We never returned to the Fed's inflation target, which is right here at 2%. So last time we were at 2% inflation was in 2021. We have been above the Fed's target ever since. And the thing we need to pay attention to right now as we go into next year is this most recent inflection higher in CPI. So we're starting to see that yearly rate of change moving higher here once again. So we've had, I think this is about 5 months in a row now where we've had the year-over-year rate and CPI moving higher. And it's we're going to get another reading before 2025 is out. I'm recording this before that number hits, so we'll see what that CPI figure brings. But there's a couple reasons why you want to watch for CPI to potentially keep accelerating in 2026. One of those is how inflation is tracking the inflationary cycle from the 1970s. So what this chart on here does, it comes from Apollo, is it takes CPI, which is and overlays it with another time frame. So CPI from 1974, from the 1960s to the early 1980s, and this is the year-over-year rate of change. That's the blue line on here, and overlays it with CPI starting in 2014 and running it through the end of 2025, where we are now. So that's the green line. This is really interesting how closely this inflation cycle has been tracking what we had in the 1970s. And you recall the 1970s was the era of stagflation. We had a period characterized by both high inflation and high unemployment. Now, there's really two from that era, two big inflation waves. We had one inflation wave that peaked out around 1974, 1975. That coincided with the inflation wave we had uh, here coming out of the pandemic that peaked in mid 2022. This trend of disinflation starting to track, and now here's what's interesting is that as we get to 2026, if this cycle keeps tracking, you would expect to see a much higher level of CPI. Really over the next couple years, if this tracks what we had during this 1970 cycle. Now, I would never imply that inflation is going to rise next year simply because you can overlay a chart and it points to it doing so. That's you need to have a better analysis behind it of why that could happen, and that's why I think you need to pay attention to with this cycle in mind. Pay attention to leading indicators of inflation, and so that's what the next chart on here shows. It shows the white line on here is something called the prices paid component. This comes from the ISM, and this is specifically their report covering service sector activity. So what the ISM does is they go out and they ask executives at firms in the services sector. They do this for the manufacturing sector as well, but this one specifically focuses on the service sector, and they'll ask about underlying business trends. They'll ask about new orders. They'll ask about employment trends, inventory, so on. One of the things they'll ask about is prices paid, and they'll put all these things together into a report, and they'll issue a figure around this. And 50 is the baseline figure. So if something is above 50 in these reports, it means it's expanding or it's rising. If it's below 50, it means it's contracting. And one of the things they ask about are pricing trend, the trend in input prices for firms in the services sector. And that's what the white line on here is tracking. This is tracking. It's called the prices paid index, and it corresponds to the scale over here. Here's that 50 level right there. I overlaid this with CPI. So CPI is the blue line on here corresponding to the scale on the right. And you can see that I took this back 10 years. Overall, the prices paid tends to lead changes in the CPI. So, which makes sense because you would expect, input prices in these reports to show up first before it's ultimately passed on in the form of consumer inflation. And so you can see, numerous inflection points on here. This prices paid, this white line leads changes in the CPI. So, the prices paid started to accelerate during the pandemic ahead of CPI by a couple months. It peaked, initially made this peak about almost a year before CPI ultimately peaked. So wanted to peak there. And then we followed this disinflation trend over the last couple of years. And here's what's interesting is that this PPI, there's a lot of headlines around the tariffs as being the cause of inflation. But what's interesting is this bottomed out in early 2024, so a year before anything was happening with tariffs in the trade war. This bottomed in 2024 and has been moving higher ever since. About a year later, we'll see if this holds, but we've had this low right here in CPI in mid 2025, and it's been inflecting higher ever since. So we'll see. We did have a big dip in the most recent report in the prices paid, so that's something worth noting. So we had this big pullback, but it's still well above that 50 level. And so, again, the reason I'm bringing this up is with that 1970 cycle comparison in mind that's been tracking so well, you start to look at, okay, what are some of the leading indicators of inflation saying right now? And you've had, this prices paid component on the rise. So, I think rising inflation is something to be on the lookout for into 2026. And the first question that's going to come up is, all right, what's that potentially mean for the stock market? Because the last time we saw this big inflation wave, it didn't have an impact at first. The market kept rallying during 2021 right here. And it wasn't until inflation was, getting up around 6% that, the market peaked at the start of 2022 and then rolled over. That also coincided with the Fed getting aggressive on tightening monetary policy by raising rates. But if we do see inflation keep rising, here's one thing to watch out for. So how does inflation impact the stock market? Well, a big impact is via valuation ratios. So how much you're willing to pay via a PE ratio for the S&P 500, for the stock market. And so what this does is this looks at, under different inflation scenarios, under different CPI inflation ranges and regimes, what does the average S&P 500 PE ratio look like? And you can see the sweet spot. I talked about this at the very start, and when we had that goal, when I called it the Goldilocks zone for inflation heading into the pandemic, that was in this under 2 to 4% range, and that is called the sweet spot for the PE ratio. You see PE ratio averaging around 18 to 19 times in that scenario, which is the highest on here. As inflation starts to move above 4%, again, this is using historical data. Now, as inflation starts to move above 4%, now you start to see an impact to PE ratios. As you start to get above 6%, even more so. And my head is blocking this bar on here, but this is when you have inflation over 8%. Recall the last time we were looking at, I mentioned when the market really started to see an impact from rising inflation is when CPI went above that 6% number. So you can see as inflation rises, you have this impact to valuations, to the PE ratio that could be more significant heading into next year, just given the state of where valuations are at right now. They're well above historical averages, whether you're looking at, valuations looking at forward estimates or trailing figures, we're above average. So that is something to be aware of. That's what I would watch with the stock market if inflation starts to pick up, and being mindful of which one of these ranges we're in and what that could mean for valuations. Now, one area rising inflation could help is with commodities. And so this chart does something similar to the last one, but it looks at, instead of valuation, it looks at the performance of commodities under different inflation regimes. And so this takes the S&P, the GSCI. So what the GSCI is, a broad commodities index, and it looks at the average annualized return for the S&P GSCI under different inflation ranges shown up here. So commodities do very poorly historically in a low inflation environment. So returns less than zero, negative returns when inflation is basically 2% or lower. But as you start to move into higher inflation ranges, the returns get better. So when you get to a 2 to 4% range, you tend to see returns at above 10%. So you start to get into the double digits. Right now we're at 3%, and this broad commodities index has been, it's been trading sideways for the most part in the last several years. If I were to pull up a chart of that, so it's been hitting a resistance level over the last several years, but along the way it's been making higher lows. So that tends to be a bullish pattern. But we do know, within this, metals have been doing really well. Precious metals in particular, and copper's even, copper's picking up here recently. But anyway, so we're in this 2 to 4% range right now, which is associated with positive returns. As you start to move into 4 to 6 or over 6, it keeps getting even better from there. In commodities, that commodity index just absolutely ripped higher coming out of the pandemic into that inflationary environment into 2022. And guess where that commodities index peaked out at? It peaked in mid 2022 when you had inflation peak and turn lower when the disinflation trend started. So again, there could be there are going to be some challenge. If we do see inflation keep picking up, there are going to be some challenges in the stock market, but there are going to be some opportunities here as well. And there's another reason to keep commodities on your radar if this happens, and it is because commodities are historically cheap relative to equities. So one way to look at that is to take a ratio of a commodities index versus the S&P 500. And that's what this is taking that same S&P GSCI index we talked about a second ago and is dividing it by the S&P 500 so that when this line is rising, that means commodities are outperforming the S&P 500. When it's falling, that means the S&P 500 is outperforming commodities. Now, the last big, run in commodities we had, especially relative to the S&P, happened in the early 2000s and culminated into mid 2008. So as the financial crisis was getting underway and the S&P was just absolutely plunging, in the mid 2008, you had several commodities continuing to rally, namely oil. And oil prices didn't really peak until mid 2008 when the sell-off in the stock market was well underway. So you got this spike right here in this ratio. Since then, we've had this trend of the S&P 500 outperforming commodities. And I mean, this ratio relative to history has been absolutely buried. Really, this looks like it's about 2016, 2017. And we've been at these low levels. So, couple catalysts that I would look to get this ratio moving higher again. If you want to see commodities outperform the S&P, one is if we see that inflation start to accelerate even further into 2026. The other thing is in another update for the podcast here, I talked about the dollar index and some key levels on the dollar. A lot of times when you see these big run-ups in this commodities to S&P ratio, where it means commodities are outperforming, you see a big sell-off in the dollar, which makes sense. A lot of commodities are priced in U.S. dollars, and so a weak dollar tends to be a tailwind for commodities. So keep an eye on inflation and keep an eye on those inflation ranges and what that could mean for the stock market, for the S&P 500, and what that could mean for the commodities trade. So that's a couple more things to watch as we go into 2026.